Hello everybody and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, my guest today is a former metals trader from Aron and Goldman Sachs. He is now Senior Economic Advisor and Consultant to Rosland Capital. His name is Jeffrey Nichols. Jeffrey, thanks very much for coming on the show.
It's nice to be here.
All right, so you go back to the last bull market in gold, 1980,
Actually,
circa.
I go back to the 1970s.
1970s. So you've seen a complete cycle and then some. And of course, I mentioned you were with Aron, which was one of the largest bullion dealers in the world.
Really, it was preeminent.
And so you had the exposure to the physical side of gold. Tell me your impressions right now. I mean, clearly over the last, 5 or 6 years, we saw a big expansion in interest in gold. A lot of individual investment, small investors, the company that you consult for right now, Rosland Capital. Probably everybody heard their name with their eponymous TV commercials. Tell me what you make of it now as a gold trader.
Well, I have to say, near term, the future is very uncertain. I think ultimately prices are going to go up and that we will see new historic highs and maybe a multiple of the previous high before the bull cycle ends. But in the short run, the market is driven by speculators, institutional traders, companies like Goldman and JP Morgan and some of the commodity funds. And they are operating off of computer-driven models which rely in part on momentum. And as long as the momentum is down, they continue to short the market. Every time it rallies, we see the shorting coming in late in the day often, and it's institutional traders selling positions or taking short positions, and it's put a cap, if you will, on the near-term outlook. At some point, the sentiment amongst these big institutional players is going to turn more positive towards gold. Possibly it's going to require a decline in world stock markets, which is very top-heavy at the moment also. But that's where funds are being attracted from gold, from the other precious metals, into financial assets, including equities and long-term bonds.
Has gold fundamentally been a disappointment to investors? You say long-term it's going to go up. I mean, on a nominal basis, everything goes up long-term, price-wise. But I mean, in real terms, you could make the argument that it has not even surpassed the inflation-adjusted peak of 1980, despite the big run-up to $1,900 an ounce that we saw in 2012.
Yeah, I think $1,900 an ounce was a real advance over previous highs in terms of inflation-adjusted
I thought it was more like $2,200, but okay, it touched it.
But it came close anyway, and I think that there was speculative pressure as prices rose towards 1900 and massive liquidation, particularly of exchange-traded funds.
Right, like the GLD?
GLD, which has been a real sort of nemesis for the physical market. I mean, even last week we saw net selling by ETF holders. And they are largely hedge funds and other institutional players, not the retail investors.
So what you're saying, and I want you to talk about that a little bit more in depth, when you say it's a nemesis for the institutional market, are you saying it creates a distortion? Are you saying that mining companies or dealers, they're not getting a true picture of the price because of these billions and tens of billions?
Not only are they not getting an accurate description of the marketplace, but they're missing out on the fundamental changes that are going on in the world of gold and other precious metals. The growth in demand from the Asian countries, particularly India and China, has been and continues to be and will be for years to come a major buyer of gold, sufficient that gold will rise even if other economic factors and world financial factors remain negative.
But at the same time, haven't we seen output and mine supply increase to match that new demand?
No, I think we haven't actually seen sufficient rise in mine production. The mining sector has been very cautious in the last couple of years. A lot of projects have been postponed or canceled. And there are companies that are doing very well, nevertheless, but the bulk of the mining industry is still in a real quagmire.
Wasn't there, in this last cycle, particularly since the financial crash of 2008, when the overriding argument was that we were going to see hyperinflation because central banks around the world were printing money, supposedly. That never happened, but that was a huge, argument on the part of the gold bulls. I mean, how much has that kind of dented or hurt, the whole inflation specter going forward?
Well, I don't think anybody really knows. We're in uncharted territory with regard to monetary policy, but a number of prominent economists, and myself included, believe that all that money that was created over the last 4 or 5 years still has to come home to roost.
It is home. It's in the banking system, which is exactly where all reserves reside.
Have been not eager to make loans. It's been tough for large corporations even to get financing in some cases. The ones that are getting the financing are the ones that don't really need it.
Well, banks don't lend their reserves, but I digress. Let's talk about the geopolitical environment right now. We see a lot of renewed tension between the United States or the West and Russia. I mean, we thought the Cold War ended, right? It looks like we're, Cold War, redux.
Right. I think, though, that the experience of the last few years shows that the gold market needs more than geopolitical anxiety for it to go up and stay up. We may see a confluence of factors coming together by coincidence, really, with gold rising because sentiment in the marketplace has changed, because the Indians and Chinese are buying, and in an environment where gold is already rising, these world geopolitical problems could be more pronounced.
Now, what do you see as the downside floor? I mean, we've been down here a number of times in the mid to low 1100 level. It's been tested over and over again. Does this hold? I mean, I tend to think like you go back and you retest the old peak, which was 850 in 1980, remember?
I'd be shocked if we found ourselves back there. But
I have not found one person who agrees with me on that, which means it's probably a good bet.
Well, it's a good bet, I think, that we won't see $800 gold ever again. And I think before long we may be saying that about $1,900 gold. It'll be something that is in the history books rather than something we're waiting for.
It sounds like the infamous Boone Pickens will never see a $2 handle on natural gas again, which, by the way, we did see. So 1900, when will we see that again?
I'd be surprised if we don't see it within the next year.
Really? That soon?
Well,
that's a pretty bold call.
Well, the thing is that the market fundamentals are really very tight, and physical supplies are in short supply. And when the market turns more positive, it's going to be like rushing for the fire door in a movie theater. Everybody's going to want to get into gold, and it's not going to be available to them.
All that enthusiasm, I could see that getting ginned up really.
The gold that's been bought by the Chinese, by the Indians, by other Asians, by central banks, has moved from weak hands to strong hands. The people who are buying it in Shanghai or in Bombay are likely never to sell it back to the market, at least not in our lifetimes.
Well, one thing is for sure, I think buying low and selling high still is the best way to make money.
It is, and we are at a low point.
All right, Jeff Nichols, thank you very much.
Pleasure to be here.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.